Good morning, traders and investors. My name is 𝗧𝗴𝗀, and I'm the senior strategist for 𝗧𝗶𝗱𝗲. Today is Wednesday. It is the 18th of August. August is over halfway over. And boy, oh boy, September is almost around the corner. And just so you guys know, before we begin, keep in mind, in light of this discussion, August, second, third week of August, last week of August, the end of August, it's typically, historically, seasonally, the quietest time of the year. So on one end, the fact that there's not much going on right now is pretty characteristic of what should be going on during this time of year. So don't try to be a hero and don't try to force the market and don't try to get hot trades during the next 2-week period, because the markets are dead. They are quiet. They're not dead because there's something setting up. They're dead because there's this lack of liquidity and volatility, and markets are mostly random. So try not to read too much into them. We still have some statistical advantages, but not as many as we have throughout the year. We're mostly trading based on news and momentum levels at this time. So big reports yesterday. We had the retail sales that were weaker than expected. I hate to say I told you so. And we had industrial production, which was actually okay. It wasn't that bad. We've got housing starts, and FOMC minutes. It's going to be a big impact on the real estate market and the bond market. And guess what? Two markets we're going to be talking about today, the bond market and the real estate market. Imagine that. What a coincidence. Let's start up with the long bond. Now, I've been telling anybody who would listen to me that I think this thing is going to crack down, and I think we are. I think we're going to break down. I think we're going to hit the 200-day moving average. And the reason I say this is very simple. Folks, whether you like it or not, interest rates are going to go higher. Even if the Fed doesn't take action to wind down some of the bond purchases in September as they promised, they're going to do it probably in October or November or December. We're probably more likely than not, unless we have a full shutdown, which I don't think we're going to have. I think we would have already had one if Delta was that bad and people aren't dying as much as they did the first time around. And I don't mean to be so cold about it, but I'm just being factual. I don't think the Fed is going to support bond buying with the market being at all-time highs for the next year. I don't think it's going to happen. So they're going to pull the rug under all the bond buying, and it's going to cause bonds to come down. And I think bonds are going to break down and go weaker. And anytime I say bonds are weaker, bullish for interest rates. Remember that. Bonds go down, interest rates go up. So keep your eye on the bond market, and especially in light of these two reports, housing starts and FOMC, it's going to be really important to see what the Fed is thinking. For words like we may take action sooner than later, the likelihood, basically any language that dictates that they're going to start winding down faster than before is language that would mean bonds are headed down. And I think that's where we're going. And I think housing starts are going to be pretty good. In the summer, typically, housing starts are good. Even if the number's slightly down, the numbers have been going up so much lately, and they've been so bullish that I don't think it's going to make a big factor. But Wall Street's looking for about 1.61 million. And again, prior was 1.63. Both were, it looks like we're cooling. Both were missing the reports, the last three reports, but the numbers have been really, really, really good. I mean, like really, really good. So just because they're missing the numbers just a little bit doesn't mean much, because the numbers have been really, really solid. And then tomorrow we've got jobless claims and manufacturing index. We'll have a really good idea of how this inflationary pressure is hitting us on the manufacturing level. We've already seen it on the industrial production level, and then we're going to see it on the manufacturing level, which is going to be very important. Now, the sector that I'm really liking out of all the 11 major sectors in the S&P, and I looked at all of them, and I swear to you, fingers, toes crossed, I looked at all of them. We've got 11 major sectors right here. The only one that I'm really liking a lot right now is real estate. I like real estate, and I actually like tech. I know. I can't believe I'm saying it. I don't like consumer discretionary at all, but I like tech. So stay away from stocks that have a mix of consumer discretionary and tech. But hard tech that doesn't supply the end user, tech that supplies other companies, basically pure tech. Companies where when you read what they do, you're like, oh, I wouldn't have any use for that. basically a part of a machine that goes into another machine that goes into another machine. Companies that benefit the business end of tech, not the consumer end of tech. That's where you're going right now. But I think real estate, look at this. I love this flat top with prices moving higher. It's really looking good. I like it a lot. And I've got 2 real estate stocks on my radar for you today. 𝗧𝗴𝗀, let me just go to... Now, this company develops a lot of mixed properties in California, a lot of residential. They really have their stuff together. And I think we're going to see a bounce. RSI is not overdone right now. It's not overbought. I think the stock is going to move higher. We are trending right now fairly good, having a nice little pullback. And I think over the next few weeks, we're going to go higher. I see the sucker going up to 240 easy. Next one, Camden Property Trust. Notice, look at how they look, almost identical. And if you look and see what they do, and remember, there's interest here, interest as well. So if interest rates start going higher and if bonds go lower, there may be more interest in these. In other words, yield on the. A lot of people buy these REITs because they have a high dividend yield. So and look at the dividend yield, went up 18% in the last 5 years. The point is, you may get better interest, better income from these properties than you do from the bond market, even though interest rates are going higher. But typically, these stocks are fairly friendly to interest rates because real estate is one of those things that goes with interest rates. It's not too because what will happen is prices will slow down, interest rates will go higher. But I like these stocks. I like the fact that it's breaking above the 50-day moving average. It's a strong stock. It's a first pullback from a swing high. And again, if you look at the profile of the stock, you will see one of the largest publicly traded multifamily companies. I like multifamily companies. I think single-family stocks are way overbought right now. The company has been doing really, really well. Annual sales are up. The performance is up. The company is starting to come back out of this nastiness that we call COVID. And I mean, look at this trend. So 𝗧𝗴𝗀 and CPT, Camden Property. I like these 2 stocks right now. It's all about real estate, especially with housing starts and permits coming. And by the way, the market's going to open up kind of random. Notice a little bit up on the Nasdaq, not 85 down yet on the Dow, up on the S&P. This is typical August. So don't be a hero and don't try to read too much into a market that's choppy and go for the low-hanging fruit. And real estate right now, and these REITs are definitely the low-hanging fruit. Now, folks, before I let you go, I've got something important for you. There's a massive discovery that could help everyday traders just like you grab triple-digit windfalls from the market from a simple 0.01 rating formula. And Wall Street expert, this guy's a champion, Chuck Hughes, he's been able to use the formula to signal a recent 96.2% win rate on over 100 positions. Now, for the first time ever, he's going to share it with the world. Click on the link below to learn more about 0.01 rating and Chuck's 𝗎𝗓 strategy. Folks, you don't want to miss out. This is brand new. Chuck has never done this before. You've got to check this out. Chuck is on fire. 96.2% win rate. Chuck Hughes, world heavyweight trading champion. You cannot afford to miss this. Click on the link below to learn more about his 0.01 rating and Chuck's 𝗎𝗓 strategy. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. Folks, stay ahead of the market by being the first to be notified when I post my next video just for you. And check out the real estate market, 𝗧𝗴𝗀, Camden Property. These stocks are hot, red hot. Talk to you guys soon. Bye.